Let's go now to our guest, Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thanks for having me.
So we're down a little bit from like a week or two ago. We recorded on Wednesday of last week. You were saying that it felt like maybe in crypto and possibly all markets you could get another leg higher, but then some stagnancy. I mean, it kind of feels a little stagnant now, but I mean, again, 115K BTC again, like it's a high price.
Yeah.
We've been sitting here when it was 16K.
Yeah. I remember those days.
So it's like 8 times as high, but
Yeah.
Either Bitcoin or the market in general, like what does it look like to you at the moment?
Yeah. I mean, let's just go through it by asset class. I think in fixed income, you've had a lot priced into the rate curve. So you've got about 60 basis points priced out to the December meeting. There's like 22, 23 basis points for the SEP meeting. And so the Fed is expected to start cutting in September, for Jackson Hole. And they're expected to continue cutting for the rest of the year. And that is largely based upon growth and employment figures that are showing warning signs, basically. You had a almost 250,000 downward revision in the job series last week. And
Right.
so, that's pretty meaningful.
Yeah, let's talk about the jobs number because
Yeah.
it obviously preceded the firing of the head of the BLS by President Trump. But I was reading Joe Weisenthal's commentary on this, and I guess one of the things that people were most concerned about, other than the top line numbers, is just that like what is actually growing? Where have the remaining jobs actually come from? And it's like in-home healthcare services for older
Boomers.
people. Yeah, and like what was it? There's one other main category I'm forgetting, but not like particularly bullish. Like
Yeah, the
areas
private
of
payrolls
growth.
stuff was weak. Yeah.
Yeah.
It's not, but it's such a weird situation. Again, you've got the immigration dynamics that are lowering labor supply.
True.
And then, demand's coming down because the economy's slowing a little bit. And so it's really strange. Like, if you look at the unemployment rate, though, at 4.2%, it still suggests that you're close to full employment. Now, there's some other metrics with respect to underemployment that are reasonably elevated, and some stuff that just doesn't get picked up in the data series because we don't really think about it that way, right? It's like, okay, a college computer science graduate gets a job at a firm that has nothing to do with computer science, but he's counted as employed. But the guy didn't take out 200 grand in student loan debt for
Work at an insurance company or something.
Correct.
Yeah.
Right. And so there's elements of weakness across the board. But again, the economy isn't markets, and I would say, given how big markets are, you can make a reasonable case that markets are more the economy than the other way around. And so even if we do see this weakness in markets, that might not, in the economic figures, that might not translate itself into pain in the equity sector quite yet. And I still think there's some technical dynamics that might push stocks higher. And so, there's a level of under positioning amongst institutional investors. You're seeing like a pretty decent short squeeze today in names like Apple, which is pretty large and a huge portion of the index.
I mean, it's second or third largest company in the world?
Yeah,
First?
and I think it's behind NVIDIA
now,
and
but
Microsoft, I
but
think.
it's okay.
Yeah.
Top 5, top
Yeah,
3.
top 5, yeah. Top 3, yeah. That's
Yep.
probably the number 3.
Yeah.
But the point being is, there's still a ton of retail flow that's going in every single day. Some of the retail buying stats are just out of this world, like such consecutive days of just net retail buying. And institutions that are a little underweight and might be forced to chase if the index, moves higher. And so there's some technical factors that might continue to push, equity markets higher. And so that's why the S&P and NASDAQ, and corporate earnings have been really good. And there's, you're back in, corporate buyback season again. And so, you've got solid earnings, you've got a pretty nice fiscal backdrop of, government spending, you've got technical factors. And so, there's a really clean path for stocks to continue to trend higher over the course of the year. But I do think that, like we're probably a little overextended right now, and so there might just need to be like a little bit of position clearing,
Mhm.
for the trend higher to resume. But I think you're within eye shot of call it 2-3% of local top before you correct and then resume the trend higher and stuff. And I think crypto will likely follow suit. Is kind of my view on markets at this point in time. In FX, you have, you know, dollar had rallied a ton, but now, euro's trading back above 116.50.
Yeah.
And so, the dollar trade, dollar weaker trade is still alive and well in markets, although you've had a huge positioning, kind of flush out. And so, I think the pain trade right now is probably for dollars to weaken a bit further. Um, and yeah, and then on the commodity side, like gold is within spitting distance of all-time highs. And no matter what the geopolitical pressures do to oil on a short-term basis, like the long-term dynamics are there's still a ton of supply and OPEC is continuing to pump oil. And so, like all the rallies in oil this year have basically been faded. And
Yeah.
like I think that trend continues. And so you're in a place in the market where Q4 should be strong because of how much money the government is spending,
Yeah. The
because of
beautiful bill, the
the
big beautiful
big
bill.
beautiful bill. You also have corporations that by and large are doing quite well, and they might actually have some like money to spend because now you don't have the tariff uncertainty anymore. So in
Right.
terms of capex, right, folks probably feel a little bit more comfortable in Q4, putting that money to work, knowing where tariff policy is for sure. And so if you're a company that needs to move manufacturing back onshore, you know that for sure now. And so you're probably going to start to invest because it takes time to get all the resources, the
Hmm.
the
Hmm.
labor, the zoning, the permitting, etc. And so now you feel a lot more comfortable making that decision. And so I think between the big beautiful bill, between corporate capex and a consumer that's still reasonably strong and a market that hasn't really broken, like Q4 should probably be a decent nominal growth quarter, which again weighs against the Fed that looks like they're about to cut. And so it doesn't really make much sense to me
To cut.
to cut.
Yeah.
And and you don't even know like what the realistic tariff impacts are going to be till like months down the line.
Right.
Is it a one-off or does it create more persistent, price pressures? And even if like you don't create the more persistent price pressures, the underlying rate of inflation is still super elevated. Like before these tariffs, you're talking about core PCE that's still 70 bips plus above target. We haven't even seen below 2% in 4+ years. We haven't been at the
It's
inflation
still running
target.
hot.
Still running hot.
Yeah.
Right. But I think that this presidency is committed to running the economy as hot as possible. Right. Like I do agree with the decision that something needs to change in the BLS.
Yep.
How they record the data has been poor. Right. And nobody trades on the revisions until
We
this
talked
week,
about this
basically.
exactly a year ago.
People have been
There was like
saying
a
it for
massive
years.
revision that
Yeah.
when we talked about it here.
And
Yeah.
like the argument people make now is just like, guys, we have AI. We have all the data in the world. Like, God forbid the number doesn't get adjusted by like huge orders of magnitude.
Yeah. Surely
Like,
there's got to be something that can be done.
right? And like the private payroll companies do a pretty good job. Like ADP has been much more accurate than NFP. Right. But people are like, no, that's not the measure that the Fed uses. So like it's like less relevant. But
Right. Interesting.
again, that's based on like real
Actual
data.
jobs and people that work. Yeah.
So it's a really interesting set of market conditions.
Sort of like converging trends too, right? Like
Yeah.
in some cases opposing trends.
But the things that we know for sure are there's the big beautiful bill, that money will be spent, right? For sure.
Hmm.
We do know that spending of that money necessitates raising of that money. So, debt issuance is going to continue to increase. And we've already seen that. Like this week alone, you had, I believe, the largest T-bill issuance ever as part of like normal auctions, which was like I think it was like $100 billion issued in like one specific T-bill, which is like crazy. But also like, you had weird price action today. Like 10-year yields just jumped by like 5+ basis points in the middle of the day on no headline. It was just like a weird pop, right? That is a sign of like some kind of illiquidity
I mean,
in
someone was
that.
just selling and it was slightly illiquid in that tenor or something like that.
Somebody might have fat fingered, who knows? But like that's the type of stuff you get when a market's kind of thin
Yeah.
on liquidity, these outsized moves. And so you're at the point in the reserve cycle, in the debt cycle, where the spending a ton of money is going to have consequences within the market. And so if you're going to be spending a lot of money and driving inflation higher, ultimately via that spending and via tariffs, but also simultaneously cutting rates, right? Like that's bad for the dollar. And so, over time, the big picture trends like are not changing, right? Like there are consequences to spending a ton of money. And you might create a bubble in that market. And, there's, one of the guys internally that's been on the podcast, I was talking to Chris Ryan today, and he seemed pretty convinced that, until you get to like these super frothy bubble-esque levels, nobody will take the job of getting inflation down like that seriously, right? And part of it is because of the system we've built where it never makes sense for a politician to make the hard choices, right? It's like, hey, I'm going to raise your taxes.
Yeah.
Hey,
Cut
I'm
spending.
going to cut spending. Grandma, grandpa,
Sorry.
like I know you were looking to retire at 65, but wait, we might have to push that to 70. Oh, your Social Security check, where we've constantly done the inflation adjustments. Maybe that needs to be less. Hey, war hawks. I get it. You want F-35s everywhere. You want to
Get
be
all the
able to
bad guys.
bomb anyone at any time. You want to put some shit on the moon. I get it. But maybe we got to reduce that by 10, 20%.
Right.
Maybe your district might lose like 1,000 military jobs. Like nobody is willing to have these hard conversations because the incentive model for people to do these things is not there. Right? And so how do you deal with an issue where nobody has an incentive to properly deal with it? Like
It's a conundrum. This is why the debt is what, 40 trillion almost, or wherever we are now.
Does it
35?
even matter right now?
Doesn't it? So high.
It does matter, which is why
It's just so
we're
easy
here.
to kick the can. To your point, right? It's my 3-year-old's not the one voting.
Correct. And the flip side to that argument is like, okay, look at the level of wealth in the U.S. Like you could easily like just tax people to death eventually, but like at what cost, right? And the issue that people don't realize is that over time, because of mathematically how debt works, right, the consequence is increasing, right? The cost of fixing the issue over time only goes up. And so, you're at this weird point where it's like everybody knows it's an issue. People run on the fact that they'll change that issue when they get in office. And then when you get in office, it's like,
I don't know, man. Tough decision.
can't do it.
Yep.
Murkowski needs a bridge to nowhere to get this bill passed. Sorry, here's an extra $50 billion. Like,
here's a bridge. Yeah.
Like,
yeah, I mean,
again, Murkowski. I don't know the
want,
details there.
Yeah, but unless
like,
you want to be very upset, like, don't put the big beautiful bill into the O3 model of ChatGPT and ask it to find you the most outlandish things that were spent on.
I'm doing that immediately.
Don't do it. Don't do it. This is great, Beimnet. I know it's a tricky time. It continues to be. What would it take for the animal spirits to come back?
I think they might be on their way back because this
it
administration
does,
is so pro business, right? It's pro spending, right? It's pro like really loose monetary policy,
Yeah.
right? And it's gonna, it seems like the end outcome is like there's gonna be a bubble if we're not in one already.
Yep.
Right, and so there's. Yeah, it's just hard.
It's hard.
It's just hard. And Bitcoin and gold seem like really easy, hedges for that trade. But ultimately, if the fix to this issue is massive deflation or massive growth shock, like those assets are also not going to perform.
Right.
Right. And so it's like, right. Okay. You
got to meet
There's a debt crisis in markets. How do you solve a debt crisis? Austerity. right? Like
Hurt,
spending
which
less.
hurts the economy.
Right. Well, yeah. What do you think Bitcoin's going to do when people wake up and are like, "Oh, I have come to Jesus on debt"?
Yeah, you want to
But in
think
the
that.
meantime,
Yeah,
like
yeah.
so
Well, I guess you got to meet Mr. Market where he is, and not you
can't
get the
fight the
market
market.
you have, not the one
Yeah.
necessarily you wish you'd have. It's complicated, but it remains exciting. Beimnet Abebe from Galaxy Trading. Thank you so much.
Thanks.